In high seas or calm, both opportunity and risk lurk just below the surface. Answers require in-depth analysis. Welcome to BlackFin Group's Shark Cage podcast, where experts dip below the surface of important industry issues in search of hidden opportunities.
Good day, folks, and welcome to the Shark Cage BlackFin's podcast series. My name is Keith Kemp, President and CEO of BlackFin. I'll be your host today. To start, I want to thank our sponsors. A special shout out to all of BlackFin's preferred partners: Prudent AI, Take 3 Tech, MortgageFlex, Encino, Cloud Virgo, LendingPad, and many, many more, all doing absolutely great things for the industry. So I'm really excited about today's special edition of the Shark Cage because today I've invited my own colleagues here at BlackFin to step inside the cage and really talk about what's going on in today's mortgage markets. You know, just having an open and honest dialogue around what are some of the real perceived or even potential challenges, opportunities, and threats ahead for mortgage in 2024. But just before we get started, let me formally introduce the BlackFin members joining us today. First, we have Bill Corbett. Bill's partner and managing director of our mortgage strategy consulting practice, a 30-year veteran of the mortgage banking financial services industry. Bill's been with BlackFin Group for going on 5 years now. Love it, Bill. It's been great working with you. Bill's executive leadership background spans from community banks and independent mortgage bankers to a top 15 nationally recognized bank. Bill has structured and managed over $3 billion in servicing flow transactions, developed a correspondent program for Toll Brothers, and led a collaborative effort with the Federal Reserve in Boston to create Mortgage Relief Fund. So absolutely great to have Bill. Andrew Weiss, partner and managing director of our technology consulting practice. Andrew's been consulting mortgage technology for over 35 years. Project engagements included advising lenders on selecting the right technology, implementations, helping lenders with optimizing their current tech stacks. He previously served as SVP of platform strategy for Origins and was principal at Strathmore Group, leading technology practice with industry legend Len Tickies, and helping lenders figure out how to select the right technologies for their platforms. He was the CIO at New Penn Financial, SVP of Strategy for Bank of America, and executive consultant with Newbold Advisors, starting his career with designing and launching Fannie Mae's illustrious DU platform. So tons of experience there, obviously. Great to have you, Andrew. Lastly, but not least, we have Michael Harris, partner and managing director of our servicing consulting practice. Michael has over 20 years senior executive management experience in default servicing and mortgage servicing. He and his team are subject matter experts in all aspects of servicing, strategy, investor relations, process, compliance requirements, the list goes on. But prior to BlackFin, Michael was the president and CEO of Geneca Asset Management and was responsible for developing a pilot outsourced management program for Fannie Mae, Freddie Mac, and HUD while working with the top 10 mortgage servicing and capital markets firms. So, guys, absolutely welcome. Great to have you here. Literally an all-star cast that I'm truly honored and humbled to have on the call, and let alone have on our team. So welcome. Good to have you.
Great to be here. Thank you.
Thank you.
Well, so let's jump in, because typically I like to have a series of questions that I'll ask, very, point blank. But today I wanted to come into this call kind of like our biweekly calls that we have as an organization, where we're just talking about the industry, free flow. There's no script, folks. There's been no rehearsal on this conversation. Just really having an open, honest conversation about the mortgage industry, mortgage bankers, how executives at banks, credit unions, et cetera, should be thinking about mortgage lending in the year 2024. I harken back to one of the podcast interviews that I did with you, Bill, is around now's the best time to start a mortgage company. Do you still feel the same way? We'll dive into a lot of that here in a few minutes. But guys, just to tee this up a little bit more, and then I just can't wait to turn it over to you and just hear your perspective on 2024. But 2023 is officially in the books. There's really no reason for executive leaders at banks, credit unions, or IMBs to look back. Maybe except for a couple critical lessons that may have been learned during an extremely difficult market. But even that can be hard when, we're faced with a calamity of issues never before seen in the industry. So already here at 2024, just getting into the month of January here, the Feds have already, signaled that rate hikes are over and expect rate cuts maybe in 2024. There's this phrase I've also recently heard that's stay alive till 25. I've heard that around the industry on the streets. I'm not sure I agree with that or think that that is really a healthy outlook either for 2024. So let me ask, what should executive leadership at a bank, credit union, or independent mortgage banker go into 2024 with? How should they be thinking about the year ahead? What should they be thinking about as critical objectives in 2024? Should they be thinking of 2024 in terms of two halves? First 6 months, think this way. The next 6 months, think this way. How should they be looking at themselves from a mortgage business, operational technology, or servicing standpoint? So, with that tee up, I hope that was healthy enough for you guys. But Bill, do you want to start us off?
Yes, thanks, Keith. So I'll start off because I also play on the business origination side and supporting some clients there. And to me, the best thing that they can hear is their competitors that are talking about staying alive to 25, because they're looking too far out into the future. I think folks that are latched on to, well, is the Fed going to cut rates in the second half of the year? They're looking too far out, right? While we're not going back into 23, just look at what happened late last year. Mortgage rates dropped well over 100 basis points. That's the now that people need to be paying attention to, not crossing their fingers and hoping and looking too far in the future. Now, having said that, right, 100 basis points drop in mortgage rates is not going to lead to a large refinance boom, but it's going to start changing the calculus in terms of home buyer activity, just getting the market starting to settle down and trying to claw its way back toward normal. And it's going to be a long slog, right? We've never seen an environment before where so many people have loans at incredibly low rates, right? That's going to mess up the housing turnover dynamics for a long time. So, it's going to be really hard to forecast, but I still think if you're, again, to where I started, if you're in the survive to 25 camp, you're going to miss a lot of really good, solid opportunities this year.
Bill, I agree with you. I think there's another part of the dynamic. Generations in the mortgage business, as you and I have both lived through, we're either business is too slow to make any substantive changes, or business is too busy to make any substantive changes. And so we end up in this strange cycle of very little changes in terms of our operation. You can see it in how the cost of origination has gone up. Now, a lot of that is just a function of fixed costs without fixed volume, but it's, how can that be? How many years have we gone through this to see the same thing? So I think, to reinforce your point, those who are looking out to 25 are essentially dooming themselves to the sins of the past. And I think that to look at the market and say, was I happy with how I was in 21, 22, 23? Were my operations where they needed to be? Was my technology where it needed to be? To wait till 25 to start to take that critical look and make those decisions is going to leave you way behind the eight ball, in my view. So I think, the folks are a little more aggressive. It is a risk play for sure. There's always some risk involved when you don't know exactly, where your cash is going to be coming from in terms of new volume and new loans. But that's where the game is to be played, and people who manage that risk well and make real substantive improvements in their operation and platforms, I think are going to take that market while the others are waiting for 25.
Agreed. I think you guys make some excellent points. Bill, talking about interest rates being so low and how that impacts turnover in terms of real estate transactions overall, but you couple that also as we've talked about, the low inventory rates. So it's not only impacting real estate trades per se, but also because you're not going to find the same interest rates, but it's impacting movement as it relates to corporate relocation and everything else. People are not specifically taking jobs or relocation opportunities because of the interest rates and being able to maintain those types of housing opportunities. But Andrew, really good point in terms of, seize the day type of thing, where taking advantage of where we are right now to make those process improvements. I'm always talking about being able to make process improvements, making sure you have the right people in the room, making sure that your compliance is in check, et cetera. All the things we talk about all the time. If you're not constantly looking at that, then you are going to fall behind the 8 ball.
I think another thing just to add is that it was, people got so, pardon the expression, fat, dumb, and happy around a refi market without question, even as inventory is so small, but it's going to be much more of a purchase market imbalance. And that's something people are going to have to remember how to do. It's been a while since it's been that heavy a purchase market. And I think people, their operations and their technology isn't really tuned for that in general.
So with that said, guys, Bill, I'll go back to, our podcast interview. I mean, what's a community bank or credit union who's kind of sitting on the sidelines, or an independent mortgage banker thinking about, is now the time to go start a mortgage company? I mean, trying to balance, as Andrew said, the risk versus what you were saying is the opportunity. And then Michael, underscoring that with, you got to make sure your operations are tight, that you don't have any lost leakage when it comes to operations and strategy and how you're selling off those loans and how you're packaging them and the confidence that you won't have to buy them back. So, how's a bank executive or credit union executive or one of these guys ready on the sidelines with some cash to start a mortgage company, an independent mortgage banker, how should they be thinking about it? Is now still the best time?
Yeah. So if you start off with the bank and the credit union view, right, one of the new dynamics is the customer and retaining that customer, growing the wallet share. And whether you're totally enamored with the mortgage business or not, you're going to have customers that have housing needs. And either you serve them and make a few bucks in the process and serve your community, or they go to a competitor who is going to start chipping away at them to try and grab a deposit account and do the basic, hey, well, if you do ACH with us or with this institution, then we'll give you a little discount. And because they know once they grab onto the end of that rope, they're just going to keep reeling the customers in. So, I think just purely from the banking liquidity side, mortgage is even more of a have to have for a bank or a credit union, again, both offensively and defensively, to continue to keep their deposit franchise intact.
So let's pull on that thread a little bit more from a technology perspective, Andrew. So if I'm starting from scratch and I don't have the legacy issues where I'm outdated technology that I need to update during the year 2024, and I'm going to be starting from scratch, what's my best approach?
Well, I think there is an awful lot of positives out there from the technology perspective, particularly if you are not so wedded to a legacy platform. One way or another, whether you have a mortgage operation and you're ready to dump that legacy or whether you're starting from scratch, sort of same position. Vendors are hungry. That's always good for the buyer's market in that sense. I think also that there are a number of vendors who are providing more comprehensive services. So while the legacy platforms have an awful lot of stitching together of pieces, and there's always been this pendulum that swings between, do I assemble best of breed out of everything out there, or do I buy from one? I think that pendulum is swinging back a little bit towards buy from one, with the competency that's being displayed by some vendors across the technology spectrum. So it's not so much that you only want to buy from one, although there's certain advantages, but there's competency that you can now acquire without having to sacrifice that in terms of going with a single vendor. I think the other issue, which is worth noting, is that we're in a world that's changing from the consumer side, right? Bill was talking about the consumer. And while everyone points to studies that say, oh, with the mortgage, it's so complicated, people want to walk in, and meet with somebody face to face, that's really changing over time. And certainly with people who aren't doing their first mortgage, they really don't want to do as much. They want it to be much more self-service, not entirely self-service. And so I think that building on a technology platform that really thinks about the consumer, whether it's best of breed or a single platform, starting from the consumer's perspective is something that we're able to do now. We weren't able to do maybe 5, 10 years ago with these legacy platforms. And so worth really thinking about in terms of how you match your operations to your technology. Right?
Yeah,
It's
it's
not
really
just
good.
about the technology, even though I'm the technology guy. It's
Yeah,
about how you use that technology to really affect your customers and bring in your business and make it efficient.
dramatic point. Now, Michael, how do I mitigate risks and exposure there if I'm starting a new, pulling on that thread a little bit more in this use case of we're a bank or credit union, we're thinking about we're going to start a new mortgage company. How should we be thinking about that from an operational and a risk management standpoint, from a servicing or sub-servicing standpoint? What are some of those pillars that we need to have in place to make sure I'm well protected all the way around?
Yeah, so my thought process is kind of to elaborate upon what Andrew just mentioned. Let's focus just on legacy systems. There are always opportunities from a technological perspective, be able to create efficiency, looking at more in terms of trying to mitigate your cost per file, right? And so being able to look at, the manual processes is which always exist in servicing that. How can you leverage that? How can you automate some of those things? Andrew brings up self-servicing, which is an excellent point. You look at the customer and leveraging the customer's ability to self-service, but looking at cost profile, looking at the ways you could find efficiencies in your processes, particularly with your people and the way they're touching the systems of record, whether it's a legacy system or a new system. Making sure that you're always looking at the standard deviations associated with your processes and always digging deeper. And kind of the theme of this whole thing is looking at, now that we're kind of setting up for, let's say we're setting up for 25, which I agree with you, Keith, is not the right approach, is waiting for that, but also being able to be prepared now. And again, I look back always at cost for process, cost for file, cost per person, and how you can shore that up, either from a technology perspective or from a manual operations perspective.
So let's zoom in a little bit more. I'm going to transition off of the new, the decision to go or no go and standing up a new mortgage company. If I'm an existing mortgage company, building on your comments there, Michael, what, Bill, Andrew, one of you three, feel free to chime in. But if I have an existing mortgage operations today, I heard what you said about let's not sit on the sidelines in 2024. But what should I, as a lender, be doing tactically over the next 6 to 12 months? You guys highlighted it at really the 50,000-foot level, to be thinking more strategically about technology, about your processes, about the opportunity that's out there, and make sure that you're helping your organizations capitalize on the opportunity. What should an organization be doing tactically on the day-to-day over the next 6 months? What should their focus be the next 6 months, and then potentially the next 6 months of 2024?
Well, I think one of the ways to start to look at it, and as Michael says, we measure everything around cost to produce. And I tend to then take that down to the 5-foot level and say, okay, we have Susie. Susie does a wide variety of tasks during the day. If we can take those tasks and eliminate 5 minutes out of it for 12 separate things that go on during the day, we've just saved an hour. Then you look at, well, what higher value add things can Susie do in that additional hour? And you just you keep going. Again, it's ground level blocking and tackling of task by task because I found when I explain it to somebody that way, that I've taken an hour out of somebody's day. That's where it seems to resonate versus this broad cost per loan number. And that applies whether it's basic process or whether it's technology and process. And a lot of the, you know, that's a lot of folks spent a lot of money on technology over the recent past, and they're not using it to its fullest potential. And a lot of that comes down to how the people and the technology interact. So I tend to crash it right down to the ground level and start person by person. What are they doing? How can we make that individual more efficient? And then you've started to save some serious amount of time and money.
Yeah,
Yeah,
I want to.
okay.
Sorry, Michael. I want to reinforce Bill's point about people not using the technology they have, because I think that's certainly true. I think the other thing that is also true is that people are not using technology that they have been offered but have yet to take them up on. Vendors are adding new features and functions all the time. And so often I walk into a shop and I see that they paid for stuff that they're just not using. And to Bill's point about those 5-minute savings and tasks, there are lots of places where people really don't need to be doing stuff at all that they are continuing to do. And it comes in two big forms in my experience. One is what I like to call the checkers checking on the checkers. When they're really, if you do that for a year and you find that you're not getting any value from those fixes, then why do you need to keep doing it? You either need to fix that process and not need the checkers checkered, or you need to stop checking, right? So that's one area. The other area I would suggest is where people have bought technology to allow things and they don't trust it. And so they're redoing it. I mean, I literally have seen some customers doing on spreadsheets or, God forbid, 10 key calculators, redoing income analyses that the systems do for them in a much more reliable way. And so it's that confidence in the system. And that takes some real management skill to first identify that and then to get people over that hump.
No, Andrew, I was going to tee that up for you, to be quite honest with you, because I knew you're going to go right down that road. Is that as an operational leader, the greatest mistake you could possibly make is the assumption that your users are using technology efficiently. And if you look at, the old school, shadow training or whatever you want to call it, you can find individuals, just like Andrew alluded to, using systems in various ways, and most importantly, very ineffective ways, increasing minutes per file, cost per file, and the whole thing. Jumping back to something Bill said, not to go too deep into process QA, but the inefficiencies in processes are always in the intermediate steps. It's not the big steps. It's the handoffs between individuals, handoffs between process steps that get lost. And the assumption is that A plus B equals C, and it just doesn't. And so always being able to double check and look deeper into how you're handing things off, how your users are communicating with each other. I mean, I look always from a servicing perspective, because that's my background rather than so much origination. But I look at just the process of borrower contact, borrower communication, those types of activities, which is sometimes manual processes, and looking at the way that's being recorded in the system, how it's being prompted, how it's being managed, how it's being communicated within your own company, et cetera. So that's where I kind of go into really looking at the deeper dive, as Bill was mentioning.
I love that you're touching on, the fact that we're not really optimizing technology, because I think we've promoted that particular talking point. Our marketing team grabbed a hold of that, some statistic where only like 60% of all existing technology in the universe is actually being used, which means there's a ton of opportunity and lift there. When it comes to being able to optimize processes, optimize technology, get away from the checker and the redundancy that we just have because we're fearful that the technology is not going to work and I'm going to have to buy back a loan. Mentally, we need to adjust our expectations and trust the technology. If the organization signed off on the technology, we don't need to have a check on the checker. That's why we have testing and things like that. So let me challenge you guys by asking, okay, those are great ideas as to, tactical things that we can do from an operational, from an procedural, from a day-to-day standpoint. Now, I know all of you are knee deep in this with different clients at different levels, as they are acknowledging we need some help because we're kind of, we've sung ourselves to sleep in our own process, and we can't quite see the forest through the trees because we're so glued to our day-to-day operation. So an outsider perspective is proving extremely valuable. So what do you say to all those lenders that are paralyzed right now? I mean, we all have to agree 2023 was a paralyzing year for lenders. It was literally trying to survive through the year, not making much money on any deals, so they had no liquidity to really invest in any particular opportunities. So what's your message to lenders to kind of, I don't want to say shock them, but awaken them to, you got to get on it in 2024, because if you're not, you're going to get left behind in 2025 by those who are building new operational procedures, or those like your clients that you're serving right now, the three of you, is we're helping you look at your entire end-to-end organization. We're doing the fine-tune, optimization. But what about those lenders that are still paralyzed by 2023? What's your message to them?
My message is always around having a look to understand where they want to be, what kind of lender they want to be. If they're happy with the way their business was, then there isn't a whole lot of need for change. And it's amazing as you talk up and down the ranks of a company where that perspective may vary from management down to the line workers. And so understanding that and understanding where they want to be, I think is important, and not terribly expensive, even, using consultants such as ourselves, which is usually helpful because we do bring an outside perspective, but it doesn't cost a ton of money to do that. And the value of that's very high. Once you understand that, then it makes more sense to do some of the either tactical or potentially strategic things to be more aligned with where you want to be as a lender or as a servicer, what have you. And I think that this, back to the idea of the people starting up a new company, they're not burdened with the same past, except from their own past, right? Many of them had companies before they got out, they now want to go back. Do they want to go back the same way they were before? It's a question that frequently isn't really asked. So that's where I would start. And I think that's something you can do and then grow from that point.
Yeah,
That's good.
I think there are a couple of other things in there to look at, and we talk about 25, but really what folks need to be looking at is what's their view of the environment from 25 through 28, 29, 30, right? There's a lot of demographic data that the home buyer group is going to be growing for quite a while, and going back, so as folks are taking a longer view, right? Are they, to Andrew's point, are they looking to make incremental changes now, which they may run out of time to make if things pick up dramatically in 25? Or are they looking to take this opportunity to make a strategic directional change? And some of it is, if volume is not that strong right now, you can pull some of your senior people out of their day-to-day activities to make this strategic change, right? To Andrew's point, I think that first is getting a real clear understanding of what their vision is. If they're trying to make tactical changes to just get to 25, then that takes them down one path. But if they're have the ability and the mindset to plan for the longer term, then there's a whole nother set of options on the table.
I might add one other point, which is that there's a tendency for lenders to look at all loans the same. And so understanding your market and your ability to flex. Clearly, a refinance and a purchase aren't the same. First-time home buyer may be very different than that the person such as myself who's had 3 or 4 mortgages, if I want to move to a new home, I know what I'm doing. Certainly someone with an 800 credit score and a 60 LTV should be handled differently than someone that's just at the margins of whatever your DTI calculation needs to be, that kind of stuff. And there is a tendency to process every loan as if it's the worst, riskiest loan that it is. And that could be. And that does drive costs up without question. And so being able to understand the demographics of the market you're going after, to Bill's point about future demographics, and understand how you do want to think about stratifying your own operations and maybe making different parts more flexible, more fungible across knowledge, right? Why should, an underwriter only be able to do purchases, right? Should be able to do both purchase and refi. What does it take to be able to do that smoothly? Or do you need to specialize? Government loans, FHA loans are fairly different from an underwriting perspective than, a conventional conforming loan. So how do you want to make those distinctions? How do you want to staff for that? Those are the kinds of things that, are a level down that I think people really want to dig into.
That's fantastic. Great way to underscore Bill's comments. We've been talking a lot about the operational and tactical side of things, and I appreciate you guys really delving into that and giving, our listeners, 3 to 5 key things that they could be doing right away to have the biggest, highest impact going into 2024, and then really teeing up for a good 25 and beyond. Michael, let's transition a little bit of the discussion back to risk. So we've been anticipating that default rates would be going up, and we're still not seeing that. Everybody, listen to CNBC every day, and they're continuing to talk about a soft landing. Some people are talking about a hard landing. Some people are talking about no landing. I just, we're all over the board. Economic indicators indicate we're not as bad, that inflation's coming down. So how are we supposed to read that from a risk standpoint, from a servicing standpoint? What's my risk? What's my exposure there? Can you provide us some clarity there as to what's really going on behind the scenes?
Well, I can tell you what I'm hearing and what I'm seeing in terms of my conversations within the default servicing industry. I mean, from a real number standpoint, you look at delinquencies going up in third quarter over second quarter by 25 basis points. Again, the rates are very low against historical averages, but there is a slight trend. Late day delinquencies are still not increasing. It's probably just because there is still a little bit of cash out there. But we've talked about in different conversations kind of the leading indicators of a potential problem down the line, such as huge credit card debt within our country right now, historic low savings amount, the real money supply, which is basically anything that can be liquidated, whether it be, coins, deposit stocks, whatever. That's at a historic low as well. Those are not good indicators for what's coming down the line. The conversations I've had is really talking about making sure that you get in front of it from a delinquency standpoint. What type of resources are you going to allocate towards that to stay in front of delinquencies to make sure they don't transition into defaults? The status quo is to throw bodies at it. Are you going to move people from origination to loss mitigation, or are you going to go and train or hire true loss mitigators? It's a completely different skill set to make sure that you stop the delinquencies before they become late stage or potentially even defaults. And those types of things right now, making sure you have your ducks in a row, kind of leading back to this bigger conversation we've had, and still it leaks back to operationally making sure your cost per loan is low. But the other side of it is make sure you have the right butts in the seats to be able to talk to your borrowers and get ahead of any types of problems. From a default standpoint and timing, many thought that would be an increase by now. Obviously, interest rates are really low. There's probably, again, some cash out there. But the other side of it is that, this is not going to be a 2008, 2012 play, which was, a huge flood, a tsunami, so to speak. This will be a longer draw, slower play out, but and probably obviously not as large. I don't think anything like 2008 will ever happen again for obvious reasons. To mention a few, just obviously in terms of workout programs and loss mitigation practices are all-time high.
Capital requirements.
Very efficient, let alone, compliance requirements, keeping everybody in check. But, don't let that lull you to sleep to think, because when it does happen, it'll happen fairly quickly. And to making sure, again, you have the right tactics, you have this right strategy to get in front of it. Because as we've seen, so, we've talked about the cycles we've seen being in the industry for a while. We've seen these things happen really fast. And from an operational perspective, if you're not in front of it, it's a very big problem for you from a cost perspective.
Well said. Bill, anything to add on the risk standpoint?
No, I think Michael hit it pretty well. There's always the secondary risk side, right? Which is when you get volatile rate environments and volume changing, that's you just have to stay disciplined. If you're of the mindset that you're going to acquire mortgages to bet in your hedging strategy, then just go bet. You don't need the mortgage part. Stay disciplined, manage things very closely. Leakage in 2021, 2022, extension fees, not really paying attention to the ancillary things in your hedge pipeline was no big deal. Right now, it's maybe the difference between keeping the lights on or not. So you have to be disciplined and don't bet the market, because as we've seen recently, right at late December, we had the largest 2-day swing in mortgage prices since they've been keeping the data. Right, if you're caught on the wrong side of that, that your company wouldn't have made it till the end of the year.
Well
One
said.
other thing I'd like to sort of mention as part of this risk is that, there's strategies around flexibility that lenders and servicers can develop. So it's one thing to try to predict what's going to happen and prepare for it. It's another thing to say, I'm not really sure what's going to happen, so let me prepare to be flexible so that I can adapt to what will happen. And those are fundamentally different strategies. And I'm not suggesting one is better than the other. Because it's probably, if you're right about betting on the future, it's probably the most efficient way to go. But if you're not sure, you can get hurt. I think they both have their value, but understanding that they're different and understanding when you are making investments of time, energy, money, technology, whatever it might be, on being more adaptive to what you don't know is going to happen, but something will, might be a valuable strategy for some lenders and servicers.
Well said.
Yeah,
Well said.
and Keith, another area in risk management to add in, so now you've got my wheels turning, right, is the vendor management side. And it's really two parts of the barbell, right? One is, are you working with a major vendor that may not survive? And what are your kind of macro level contingency plans and controls around that? But the other thing that's popping up, unfortunately, way too frequently, is a vendor that, because of a cyber incident that they're having, just hits the kill switch. And folks really need to, right? So everybody has their BCP plan, and you dust it off every once in a while and look at it. But it's becoming real, and it's becoming very targeted in that, we'll pick on First American, but they're only one of them. If they have a cyber breach and they hit their kill switch, and you've still got loans that are expecting to move through the process day by day, how are you going to do it?
Yeah. It's funny. It's funny because Todd on our team just finished a blog article about prepare for the catastrophe. It's going to happen. And then let alone in just the last couple of weeks, we've had some major issues. I mean, you have to be preparing for that. And how am I going to keep the lights on and keep closing business? Andrew, sorry.
Oh, no, Michael, I think.
No, I was going to mention, Bill singing my song about vendor management. Obviously, vendor management is one of the most costly relationships you have in any type of process. And, one of the things that really inhibits you is the technological advances of vendor management companies and their ability to keep up, their ability to build interfaces, ability to do electronic transactions. The other side of it is, what do you have in house to do oversight? Do you have a specific dedicated vendor management team, compliance, procurement team to do oversight and quality control over your vendor management relationships? But it goes back to I was going to mention, it kind of goes back into the conversation a little bit. I apologize, but looking at technology overall, one of the things I've learned in getting involved with this organization, where there's so many skilled individuals on the lending side, which is my weak point, mine being more servicing, default servicing, is that on the servicing side and the default servicing side, there's much more of a legacy perspectives from technology. There's not a lot of systems out there that are really advanced. So you have to think outside the box as an operator to make sure that you're looking with the best way. I know we've said this, but the best way to leverage the existing platform that you're on and potential bolt-on applications to assist in your process, particularly as it relates to vendor management relationships.
Yeah, one other point worth making around this, we've talked about, what if they go south? There are an awful lot of lenders that got really hurt because they had locked into very high minimums, and vendors are holding them to it because the vendors are scrabbling for money too. And so back to there's lots of different ways you look at risk, and vendor management is a key issue, but also those contracts and what you're willing to stand behind. People were assuming the good times would go on forever. I don't know why. It didn't take a lot of foresight to say, interest rates are so low. Are they likely to stay this low forever? Or do you think they might go up? Now, granted, they went up rapidly, maybe more rapidly than people were expecting, but betting that you'll not have to suffer some of the shocks of the larger economy seems like a strange bet. So I just, would point out that in this whole risk management melange, there's the technology risk, your vendor going down. There's the business risk of being on the wrong side of the market, as Bill pointed out. There's also just sort of the cost risk of doing, not doing good deals with your vendors. And not, having the kind of relationship with a vendor where that vendor is willing to work with you on a long-term basis because they want to have you as a customer forever, as opposed to, oh, wait a second, I just need that next, 10 loans to make my number. So just, all of these thoughts, risk has a lot of different dimensions to it. And you really need to look at all of those dimensions, I believe.
Wow. Tons of great wisdom and perspective that should be extremely valuable for our listeners and for the lenders throughout the country and executives at banks and credit unions. Any last minute pearls of wisdom that you guys wanted to make sure you touched on before we button things up here?
I would mention something, just kind of the bigger theme is that, with this opportunity now, in terms of the way we are in the market, there is an ability to lead the class. You found where there's individuals in a down market, whatever, fall by the wayside, move on, do something else, where if you persevere, you have an opportunity to not only lead the class, lead the industry, and set the precedent the way the business is supposed to be done. And I think there's an opportunity right here, right now to do that, just that.
Well said.
Yeah, I would just echo what Michael said. I mean, anytime you have turbulence in an industry, yes, there's risk, but that also means there's lots of opportunity. And so, I get you got to worry about keeping the lights on. Been there, done that. I understand it thoroughly. But on the other hand, if you can take a little part of your attention and focus on what those opportunities are, then that can really help you keep the lights on.
No, it's the message is resoundingly clear, and folks, my 2 cents would be, don't be afraid to ask for a hitting coach. I'm a big baseball fan. Anybody who knows that I've been to just about every baseball stadium at this point. Big baseball fan, and these hitters who have been in the big leagues for 10, 15, 20 years, even they need a hitting coach. They need somebody looking at their swing to coach them and review all of what they're doing, all the mechanics, and analyze their business, analyze their strategy, analyze their mechanics, and give them a little bit of coaching so that it's an outward perspective coming in, because you're just too close to it as a hitter. So I think it's okay for vendors to kind of take a step back and go, you know what, I need a coach. I need a hitting coach, whether that's BlackFin or somebody else. This wasn't designed to be self-serving. But I think that it might be okay to start 2024 off with that perspective to say, let me get a hitting coach in here, make sure I'm hitting on all the key points in my business, make sure that, I'm not only taking advantage of 24, but I'm also preparing for a great 25, an even greater 25. So if your mindset is, hey, survive 20 till 25, you're probably in the wrong mindset and should probably be taking a little bit closer look at your business. So Andrew, Bill, Michael, I want to thank you guys. This has just been absolutely great to have you guys on the phone. I look forward to our next call. Maybe we'll record that as well, just so that we can, make sure that the words of wisdom and perspectives are continue as they mature, continue to be known to the marketplace. We can share them via this podcast. So I think some great pieces here for all executives at banks, credit unions, and IMBs. Make sure they're getting the most out of mortgage in 2024. Folks, you heard it here from an all-star cast of experts with over 30, 40 years experience individually in the mortgage lending and servicing industry. There's a lot of revenue being left on the table that's currently available. 2024 is time to get all the pieces in place for scaled growth. Until next time, this has been another exciting episode in the Shark Cage. Have a great day.
Thank you.
Thank you.
That's
Thank you for joining us in the Shark Cage. To be a guest on a future episode, send an email to info@blackfin-group.com. To find out more about the show or the information provided in this episode, visit BlackFin Group online at www.blackfin-group.com.